Hello again and welcome back to my channel. My name is Patrick Allen. I'm a licensed realtor with Keller Williams Southern Arizona. And in today's video, we'll be discussing real estate. With the basics of the ABCD classification scale of real estate behind us, I still did not feel like I had covered everything that I wanted to cover in part one of this video. Now we now have a pretty good handle on the difference between a C-class area and a B-class one, but what does that mean for you exactly? Given your own level of experience, access to capital, risk tolerance, and time horizon, there very does likely exist a correct type of asset to target as a buy box. Today's video will take a deeper look at some of these parameters. What assumptions are investors making when they choose to buy and hold real estate in Arizona's market? When does it make the most sense to buy in an A-class area? And what personal considerations are important for someone new to investing or for someone who wants to be especially passive? Let's see what we can make of it. So probably the most important and the first practical thing to consider when buying real estate and holding it for a long time is this dichotomy of market growth. Is the market you're investing into considered a growth market or a cash flow market? Which is to say, are you likely to find a strong cash-on-cash return in the first few years of owning the property due to a high rent-to-price ratio in a market without a history of increases in rent over time? Or does cash flow generally only come later, after years of consistent rental increases are able to catch up to the premium that you paid for the home at the time of purchase? Relative to most other markets an investor might consider, Tucson can be considered principally as a growth market. The fundamentals suggest that both home values and rents will continue to increase over time. And there are two reasons for this: our housing supply and our housing demand. Put simply, the longer-term demand for housing in Pima County is expected to outpace our reasonable ability to provide the supply to satisfy the demand. This is because our housing supply in several ways is finite. Much of what we know about the Metro Tucson area is already built out. Midtown, Oro Valley, and the Catalina foothills are mostly made up of housing stock built in the 1940s through 1990s, while most of the new construction is concentrated on the perimeter of the city. In Vail to the southeast, or Star Valley to the southwest, or Marana to the northwest. Builders are largely restricted from developing the northeast side of town due to the Catalina mountain range, as well as to the southwest due to the Tohono O'odham reservation lands, further concentrating our new supply into the Vail, Marana, and Sahuarita areas. And although Arizona has perhaps the largest amount of undeveloped land which could theoretically be turned into housing of any state, up there with Texas and Alaska, there's still a major barrier to our ability to supply, or indeed to oversupply, our market with new homes. And that is our access to water. Pima County is primarily groundwater dependent, which we replenish with water from the Colorado River via the Central Arizona Project. And although the sustainability of the water supply has improved in recent decades due to conservation efforts, Arizona requires a developer to show a 100-year assured water supply for both current demand and future growth projections. And so, short of a major technological breakthrough, access to water will continue to serve as a headwind against future housing supply increases. However, from the demand side, all we can see is more growth. With a metro population slightly above 1 million people, 480,000 employed as of 2023, and a steadily rising area median income, Tucson has become one of multiple cities in the Smile States to benefit from relocation patterns originally seen during the pandemic. Now, Tucson is rarely ever singled out as the fastest growing city in the country, but is quietly represented in the overall trend towards warmer, more landlord-friendly locations in Arizona, Texas, Florida, and North and South Carolinas. The larger metros and warm weather locales to also do well include Nashville, Atlanta, and Las Vegas, with the bulk of the in-migration for these areas coming at the expense of older cities in cooler climates and with much greater affordability pressures like Boston, New York, and Los Angeles. And with a well-diversified economy not overly reliant on a single industry, the Tucson market continues to be a strong draw for both new job creation and for an educated workforce to do those jobs. So having said all of that, we can conclude that Tucson fits rather nicely into the description of a growth market, where a growing economy and a growing population are likely to allow for even greater opportunities properties for future long-term appreciation than what is predicted to be the national average. And so while we can describe a given area within the Tucson MSA as A class or B class, better or slightly better than the average for the city, we can similarly think of the Tucson market itself as likely to provide passive market appreciation above and beyond the US average, whatever that ends up being. And that's the good news. The other side of this same coin means that anytime you make a move on an investment property in the Tucson MSA with admittedly pretty thin cash flow, you are to some extent assuming this future growth will continue, or else the deal likely doesn't make a lot of sense on paper. And this is pretty common in Arizona, and it's what makes the current market challenging. So shifting gears away from the appreciation and growth side of things, let's now take a look at the corollary to a property's condition. Now, we've grouped properties requiring light rehabs into C-class condition and bigger rehabs into D-class, which suggests that there is some associated framework for how to turn these deals back into A or B-class condition. The 3 levels of rehab is a handy mental model to help shape what you are and are not willing to take on in your first or next value add deal. Now, for your basic rehabs on a C-class property, you're almost always going to do 3 to 5 of these relatively simple tasks as part of what we might call a basic rehab. If it is your aim to take an ugly property and make it look nicer, then you'd be surprised at the difference that you can make to a home just by redoing the flooring, painting, and maybe upgrading to some in-can ceiling lights. Now, an advanced level rehab will likely include most or all of the finish work that's included in the basic rehab scope of work, but also involves one or more of the following bigger projects now on the screen. There is a substantial increase in job complexity when we step up from a basic rehab to an advanced one. Addressing one or several of these major projects not only means more materials to buy and more man hours to complete the job, but also an elevated skill set of the vendors that you use. Licensed electricians, plumbers, roofing contractors, and general contractors must be called in to bid these jobs, and many of these vendors must work together in order to bring the project to life. And anytime you start to open up interior walls, you increase the chances of finding additional repairs not originally budgeted for, like addressing mold or termite damage inside of the drywall. And for our third and final level of rehab, we can take yet another significant step up in job cost and complexity by planning a full-blown redevelopment project. With an advanced rehab, we are largely working with the existing structure that's on the lot, while what we might call an extensive rehab is more of a reimagination of the highest and best use of what that property could be. Maybe it's because the property has been significantly damaged by a fire or flooding event, or maybe after multiple generations of add-ons to the property over time, the floor plan doesn't make any sense. Or maybe the current home is a single-family home of less than 1,000 square feet, but zoning would allow for a much larger property, or even multiple units or guest houses. Whatever your plan, it likely will mean having to demolish the current structure and rebuilding something that is essentially brand new construction. So not only will multiple permits need to be filed with the city's zoning and planning departments, but more sophisticated expertise from a home builder or an architect will need to be roped in to make sure that the new structure meets current building code. And the amount of work and time increases exponentially. There will be much more time spent coordinating different vendors as well as city workers needed to approve different stages of construction in an iterative way. All right, after what is nearly 30 minutes of video time, we're now in a pretty good spot regarding our comprehension of the ABCD scale. We've compared and contrasted every type of deal for both condition and location, and now we've discussed their corollaries. That property location within the city is relatable to Tucson's overall status as a growth or appreciating market, and that a property's condition can be altered via the 3 levels of rehab. Let's begin to wrap this topic up by offering a few practical applications and advice to this scale as we've just set it up. If you are a new investor and just doing a deal of any kind is a big stretch for your comfort zone, then it probably is best to look for a deal in B-class condition. Something that's not super sexy, but does not require updating to get it to rent-ready condition. If you are newer and interested in taking on your first or second deal involving value add, then finding a C-condition property allows for that quick and reasonably safe rehab process to get it back up into B condition. And if you do run across a deal requiring an advanced level rehab, then tread cautiously. Consider passing that deal along to a more experienced flipper or partnering with an experienced contractor who is accustomed to working on those larger projects. And particularly for the new investors that don't earn a high income at their day job and are looking to get their investment journey started, don't be too fast to pass up on those C-class locations. In general, they will not appreciate as fast as the nicer areas of town, and managing the deal over time will perhaps be more of a headache for you in the long run. But C-class locations offer more affordable starter home inventory that don't necessarily require a six-figure down payment just to get into your first deal. Buying off of the shelf in a B or B plus area will almost always tempt you into an over-leveraged position. So instead, consider buying C-class, owning it for a few years while you build up your experience and pay the loan down. And then later on, you can move up into those B-class areas with the better school districts, moving your equity gained in that first deal via something like a 1031 tax-deferred exchange. Now, for you more experienced investors targeting value add, C-condition properties are usually the most competitive product that investors are looking for. Because light rehabs are safer and faster to do, more people can pull them off, and so competition for those deals remain high. Deconditioned flips can generally be purchased for a larger discount off of the after repair value, thereby offering more reward as well as more risk. And until you've established a track record of doing a more involved flip projects, those projects are better left for the bigger players with access to more capital and a full crew of subcontractors, offering them greater economies of scale on the expense side. And as we've said before, A and B condition properties are usually not workable for value add. Generally speaking, we can only add value to a property in an efficient way when the price per square foot is already lower than what most of the homes in the neighborhood are. A value add investor should not necessarily avoid buying in an A or B plus class location, although doing so will generally limit how good of a deal you can get on the property initially. It's just more often the case that a value add project in a good or great location is a better candidate for a BRRRR deal, or a flip and hold, which involves a refinance at the end of the project and keeping it long term rather than reselling it. Finding C-class opportunities in C or D-class locations almost always make more sense to be rehabbed and resold. Not only due to a limited likelihood of future market appreciation in these areas and more property management struggles, but also a higher churn of buyers and renters moving into as well as out of the most affordable locations around town offer a larger pool of potential buyers for the property post-flip. If you're a passive investor not wanting to take on a project like renovation or property management, then I would say that A and B class locations are really all that you should be looking at. C and D class locations might look as though they offer a better return on investment, but will consume your time and attention in a way that is just not conducive with your goals. Better to find a B class property in an A or B class location, pay the premium to get into that initially, and let your professional property management team run it from there. If you're just looking for a bread and butter deal with a very long-term time horizon, A and B class locations are absolutely worth the premium to buy into them. To the degree that there is a mismatch between the number of people looking for housing in an area and the availability of housing in that area to meet that housing demand, the more long-term upside potential you have, both in terms of property values and rental rates. Finding a reasonably good deal in an A-plus location where there is limited new construction because the entire area has been developed and subdivided already, and further expansion of those areas is impossible due to natural barriers. These are all very good signs. B and even C class locations can be workable and will allow you to scale your unit count faster. However, D class locations are best avoided no matter how good the deal looks on paper. And if you feel comfortable taking on a renovation project from time to time, then taking down C class properties that you can quickly turn into B class ones will offer you more control as it relates to immediately adding equity to your portfolio. And what about those D-class areas? What type of investor does it take to make suitable returns from the lowest income brackets? Well, we could just say slumlords, and we'll certainly find our fair share of that looking in D-class areas. But more practically, the key is effective operations. The ability and, frankly, the willingness of your property management staff to collect payments and enforce lease rules, as well as your ability to make the home safe and comfortable for your tenants without over-rehabbing the property and pricing them out. Having dozens or hundreds of units in a portfolio and an expert operations team that is used to managing that type of asset can make you the one investor in 100 who can profitably own deals in those D-class locations. Those investors wanting to target Section 8, aka housing voucher tenants, can do well in C- and D-class areas, as do independently operated businesses which serve the public good, like sober living facilities or havens for victims of domestic violence. And because many investors want to avoid renting to these demographics, it could be the case that by providing safe and affordable housing options to a demographic of renter who is badly in need of housing can still produce excellent returns for the investor over time. With all of that said, I think we've pretty well covered the landscape of the ABCD classification scale of real estate. And as you continue to identify your investor buying niche and strategy, I would encourage you to look a bit more holistically at the entire market and the pros and cons of each end of this scale. It's not always the case that A-class deals are safe, whereas D-class ones are risky, nor is it always true that A-class locations never make sense of investments because they're too expensive. What you buy at any given time depends heavily on your real estate investing goals at the time, your access to capital and skilled trades to oversee a renovation project, as well as issues that can only be described as personal financial. Are you able to stomach negative cash flow for a few years on a deal with massive upside? Are you able to leave a little bit of your own cash in the deal after the rehab and refinance? Or are you able to hold on to a completed flip project for a year or two as a rental before reselling it if it means paying less in taxes when you do sell? Depending on many factors, most of which will change over a lifetime of investing in real estate, you may at times focus on acquiring a certain condition and location of a property, only to change your approach later in your lifestyle and your values change, not to mention the amount of equity that you have to deploy. But whether you consider yourself a newbie looking to get into the game, a wealth builder looking to scale a small portfolio into one that will sustain decades of retirement, or else someone who has walked the long path, built a solid financial fortress, which now must be fortified and defended, there very likely is a best way for you to approach your next real estate investment move. And for that, I do appreciate you trusting our team to help advise you along the way. So that's all I had planned for this video. We will see you on the next one.